Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. On today's show, we're talking about the repo rate. In fact, the Federal Reserve Bank of New York injected a bunch of cash, $53 billion, into the markets on Monday. News headlines on the financial papers said that this was an event that hasn't happened in a decade. The last time it happened was in 2008. The implication is that if the economy is doing so great, why is the Fed having to bail out the banking system again? The papers are just talking about a lot of confusion. Wait a minute, didn't the Federal Reserve lower interest rates just a week ago? If that's the case, why did the short-term overnight repo rate jump to over 5% in just 24 hours? That's an almost doubling of the interest rate in a very short period of time. Well, folks, this is sensational reporting at its best or at its worst. I'm not sure which it is. Now, I've known that there are multiple different overnight rates, but it took a little bit of detective work to find out exactly what the repo rate was. 2 days ago, I had no idea. Now I do. So you might be wondering, what is the repo rate? Let's say you're a depositor in a bank and you put money into something called a money market fund that has a 24-hour redemption notice period. The bank is able to loan out money that's in your money market fund, but it can't loan it out for very long because it might be called in 24 hours. So there's a market out there for these securities that can often be traded for cash, but only on a short-term basis. They've got to be traded back into the security, or into cash in this case, within a 24-hour period. These short-term 24-hour loans are used between banks all the time. It's part of the liquidity of the financial system. And on Monday this week, there was a shortage of cash in the system, and it caused a bunch of lenders and borrowers to bid up the price of these so-called repos, these short-term 24-hour loans. So the real question is, why was there a shortage of liquidity in the system? Where did all the cash go that was just there 24 hours earlier? Well, the first is that we came upon a federal tax payment deadline. Monday was the day that U.S. corporations have to pay their quarterly corporate taxes. It was a whole chunk of money that would have been sitting in accounts that all of a sudden disappeared in one day. Monday was also the day the Treasury Department auction of $78 billion in debt was scheduled to settle, meaning that $78 billion in cash was turned into securities overnight. And together, these two factors could have caused a cash shortage in the system, and with it, a short-term spike in overnight rates. Neither of these two events are a reflection of the health of the economy, or even a crisis in the financial system for that matter, but they could have been easily predicted. They could have been planned for. The fact is, tax deadlines occur every quarter, and large treasury auctions happen with great regularity. So why is it that this seems to have happened now? Why is it we don't see spikes in repo rates more frequently than we do? So the million-dollar question, or billion-dollar question, is, what does this all mean? Is this a short-term blip, or is there something more systemic, something more serious to in fact worry about in the financial system? The fact is, there's a tremendous amount of cash in the system, way more than was ever in the system back in 2008. In fact, there's over $3 trillion in excess reserves on deposit with the Federal Reserve. The Federal Reserve has printed a ton of money over the past decade. A lot of it, in fact, to shore up the bank's reserves, but they've printed way more than the banks have needed, well above the statutory reserves. Those excess reserves, the banks have in turn loaned it back to the Federal Reserve and are earning an interest rate on it. So when you read in the financial papers that the Federal Reserve has increased its balance sheet, that's really what they're talking about. It's money that has been deposited by the banks with the Federal Reserve in exchange for an interest payment. If the banks really needed cash, they could pull back some of those excess reserves. Now, they may not be able to do it overnight, but they can definitely pull back some of those excess reserves because there's a ton of liquidity in the system. I believe what we've seen on Monday is a short-term blip. It's a short-term aberration, and it's a cash crunch caused by a couple of short-term events. The news media want to grab your attention with a headline. They want you to watch their show. They want you to read their newspaper. If the headline said, nothing new to report here, move along, there's nothing that's going to sell a newspaper. They have to grab your attention with something sensational, even if it means leaving some questions unanswered. Maybe that means you'll come back again a second and a third time, hoping you'll get some answers. Well, I'm no expert on the banking system or the Federal Reserve System for that matter, but my research seems to have a fairly plausible explanation as to what's happened in the financial system in the last 24 hours. Hopefully you find that helpful. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.